In my previous video, I revealed that I had quit my finance job, but I'll admit that I didn't quite go into the specifics as to why I quit and where exactly I'm headed next. And that was on purpose. I really just wanted to capture what my headspace was like shortly before and shortly after I quit. But for this video, I wanted to address some of the questions you guys might have and also go into a bit more detail as to the next steps in my journey. To catch you guys up, right out of college, I got a job at a large investment bank here in New York City where I worked as a market risk analyst. Now, for those of you that don't know what that is, it basically involved helping the trading side of an investment bank analyze market trends and data and also analyze a bunch of risk metrics to basically ensure that the bank isn't taking on too much risk and also to potentially identify any hidden risks. I was at this role for about a year and a half. It was my first job out of college, and that brings us pretty much up to present day. Alright, so why exactly did I leave my previous job? Well, first we have to understand this concept within the finance industry called the buy side versus the sell side. If you're not familiar with it, the concept is pretty simple. As the name entails, in the world of the financial markets, there are some firms that buy securities like stocks and bonds. These types of firms include asset managers, hedge funds, pension funds, insurance companies, sovereign wealth funds, the list goes on. Essentially, these firms and organizations are the ones that do most of the investing, and they may do it for several reasons. A company like BlackRock, which is actually the world's largest asset manager, managing around $10 trillion total, has to invest its clients' money into many different assets in order to generate a return for them and in turn collect their management fee. A pension fund needs to invest its members' contributions so that their employees can have enough money when they retire. And a hedge fund actively buys and sells securities in order to try to beat the market index and return a profit to its clients. Now, this was all the buy side. On the other side, you have the sell side, which generally consists of the large Wall Street banks like Goldman Sachs, Morgan Stanley, JP Morgan that create, promote, and sell these securities to the buy side. The trading floors of these banks that I just mentioned all have different divisions that serve different functions, but they all essentially serve to market and trade securities with the buy side. So now that we have a better understanding of these two sides of the industry, I'm now going to briefly touch upon just exactly how investment banks usually make their money and how that factors into what I want to do in my career. Banks typically make their money by trading and holding inventory in certain securities like stocks, bonds, commodities, and much more, and buying them at the bid price and selling them at the ask price. And the difference between these two prices is what's called the bid-ask spread, which is the tiny profit that a market maker can make by selling the asset at a slightly higher price than what they bought it at, and essentially serves as a reward and incentive for the market maker to make the market and also to compensate them for the risk of temporarily holding that asset on their book, which can fluctuate in value. Now, bank trading desks are extremely complex, and there are so many ways that they can make money, but at the heart of it lies commissions and the bid-ask spread. But things weren't always this way. Prior to the global financial crisis, banks could actually engage in what was called proprietary trading, or prop trading for short. This essentially meant that they could make speculative trades and take directional views in the market, and make money when the market moved in their favor and lost money when it didn't. And that's probably the type of trading that most people are familiar with because, after all, that's most likely what you're doing with your own portfolio. By the way, if you want to learn more about this era of Wall Street, I'd highly recommend reading this book, Liar's Poker by Michael Lewis. I've read this book several times, and it tells the story of Salomon Brothers, which was the most profitable Wall Street bank in the 80s and 90s, largely due to their prop trading activities. Anyways, after the global financial crisis of 2008, regulators and Congress were like, all right guys, party's over, you guys can't be doing this anymore because these highly leveraged and speculative trades from the likes of Bear Stearns and Lehman Brothers are largely what got the world into this mess in the first place. And so they implemented the Volcker Rule, which essentially prohibited banks from doing any more prop trading. However, there are still some types of firms that are able to prop trade, like hedge funds. And partly due to this reason is why I've always seen hedge funds as the place I want to end up in my finance career. For the reasons I mentioned before, because hedge funds can actually take directional views in the market and are not subject to the same regulations as the big banks are, there's theoretically more upside to the investing activity. Of course, that also means there's more downside. The way I like to think about it is that these big banks are like giant oil rigs or tankers out at sea. They just need to be able to weather the storm of the financial markets because their focus is not to profit off of the directional moves in the market, but rather by facilitating the client's activities and needs. Hedge funds, on the other hand, are like these smaller, more agile boats that can actually surf and ride the waves and position themselves in a way to benefit benefit from the movement of the markets. Now, for me, career-wise, this has always been the more fascinating side of the business. After reading and learning about the legendary traders and hedge fund managers like George Soros, Stephen Cohen, Stanley Druckenmiller, and many others, I also wanted to develop this intuition and gain an understanding of the decision-making process behind these investment managers and how they manage to spot inefficiencies and dislocations within the markets and profit off of them. So ever since I learned about what the finance industry even was, I've always wanted to work at a hedge fund. I just didn't know exactly when it would happen. But one day, out of the blue, an opportunity popped up, and shortly after, I interviewed and eventually I decided to make the jump. So that is where I currently am now. Just within these past few weeks, I've learned a tremendous amount about trading, macroeconomics, and all sorts of different things. I am still working as a risk analyst, which I think is a good way for me to learn about all these different markets and strategies, and also a lot of risk management techniques, which has actually become quite the relevant topic as of late, and really just build a solid foundation. But my journey here has only begun, and I still have a long ways to go before I reach my goals in the finance industry. Now, was this the right choice? That's to be determined. I did leave behind a steady pay and career progression at my previous company, and I'm also commuting 2 hours door to door now, but ultimately, I think it'll be worth it. Because one thing I'm trying to prioritize in my 20s is just simply learning. While my role at my previous company was quite comfortable, as in I had great coworkers and I was learning new things, they weren't quite the things that I wanted to learn and wasn't quite the direction I wanted to head in. So if this new path comes with a bit more risk, I think it's a worthy trade-off, because not only will I be able to gain the skills and knowledge that better align with my long-term career goals, I'll also be able to see if this business really is a good fit for me, or if it's just something that I like the idea of. I think if there's any time for me to take risks, my 20s will be the most ideal, because I don't have anyone else to take care of except for myself. I don't have a house, kids, any familial duties, so I'm really just trying to soak up as much knowledge as I can and see what's out there. Reflecting on the past year and a half of my career, I think one thing that I did do right was always keeping my eyes on the end goal of where I wanted to be in the next 5 or 10 years or so. And every opportunity that came my way, I measured it against that goal to see if it would get me closer. There were many days at my old role where I was frustrated and discouraged with the lack of progress I was making, but I would always remind myself that if I never lose sight of what I want and never compare myself to where others are at and just stick to my own path, good things will eventually come.